2016 has come to a close. Let's recap our various portfolios and see how we did. Welcome to another episode of the VMC Inc. Financial News Network. I'm your host, Victor Campos. At the start of 2016, we set up 3 portfolios. Let's take a look at how each one has fared this year and perhaps look ahead to 2017. We'll start off with our tech stocks portfolio. This is a portfolio of 10 tech stocks. On the last trading day of 2016, December 30th, we can see that most of our stocks had a bad day. Our one-day performance for most of our stocks was in the red. GoPro losing the most, 1.47% value, followed by Netflix, Microsoft, and so forth. While at the top of the heap, Angie's List had a one-day performance that was good, 0.61%. In actual dollars, that was a 5-cent increase for Angie's List, and their stock price ended the year at $8.23, followed by Etsy at $11.78, which was a gain of 2 cents, and the last positive of the year was Nintendo at $25.95, gaining 1 cent, or 0.04%. At the bottom, Netflix lost $1.53, Apple 88 cents, and Microsoft 73 cents. Well, that was just a one-day view. We've held onto these stocks for a whole year. Let's take a larger view and see if we have any positive results. By looking at our holdings since purchase, we have a much better picture. Arranging things from negative to positive, GoPro has not been a good investment in the year 2016. We lost $9.98, which was 53% of its value. Twitter has also not been a good investment this year. We lost 27% of its value. Activision, which was doing pretty well through most of 2016, ended up with a loss of 4%, which was $1.51. Angie's List, which was at the top when we only took into account one day, actually lost 90 cents throughout the year, which was nearly 10% of its value. Well, on to the good news. Square has resulted in a 12% increase in value. We added $1.47 per share. Etsy was even better at nearly 43% increase in value, $3.54 since the beginning of the year. Microsoft gave us $7.37 increase. Nintendo increased $8.70, which was a whopping 50% increase in our investment from a year ago. Apple gave back $10.50 for the year, just about 10% value. And Netflix was $13.84 added on to the stock price, $12.59. At the start of our year, January 3rd, 2016, we purchased 1 share of these 10 tech stocks at a cost of $395.74, not including commissions, which resulted in an ending value of $422.51, which was an increase of $26.78, or 6.77%. Very good return on our investment there. Imagine if you had purchased more than 1 share of these stocks. If we were going to rebalance for 2017, perhaps I would finally dump GoPro. It just seems that their better days are way behind them. Hard to believe that GoPro was $98 a share shortly after the IPO a couple of years ago. Now it's $8 per share. It may be time to dump this stock. Twitter I've got a love-hate relationship with Twitter. I love using the service, but I hate owning the stock. So maybe it's time to dump Twitter. They just haven't been able to pull it together. And it was also trading at over $70 per share at its height. Now it's down to $16. Angie's List. I don't see it climbing back to its heyday of the $30 range. Activision. I would hold on to Activision. I wouldn't count them out. They've lost 4% of their value this year, but Activision is a big, powerful video game company with a variety of titles still to come out, so I'd hold on to Activision. Apple, of course, hold. Square. I'm still iffy on Square, even though we're starting to see a turnaround. But at such a bargain price, I'd hold on. Netflix. There's still challenges ahead for Netflix since there are so many competitors now. Amazon, Hulu, etc. Microsoft. Always hold Microsoft. They've increased their dividend yields time after time. The stock price has really performed well in 2016, and with Windows 10 on the rise, I think so will its stock. Etsy. I think at the moment, if you held on to Etsy this year, you were lucky, but if you bought Etsy during IPO, it'd be time to dump it. Etsy was at about $30 a share in 2015, and a 42% increase in 2016 is nothing to sneeze at, but if you start investing now, you probably won't be in for a lot of returns. And Nintendo. With a new generation of game consoles coming out and their long overdue adoption of mobile platforms, I think Nintendo is definitely a buy and hold. Next up, we've got our 401k portfolio. We've got 3 funds, a bond fund, and 2 stock funds. A domestic stock fund and an international stock fund. Our one-day performance at the end of 2016 has yielded all positive increases. 2 cents for bonds, 1 cent for domestic stocks, 5 cents for international stocks. Looking at the data in another way, since purchase, the Developed International Stocks Fund lost 10 cents in 2016, which was a 0.85% decrease. There was a lot of international instability. England, Germany, China, and all of that made for some very choppy waters abroad. So our developed markets fund suffered. Our bond fund lost 1 cent, which was 0.09% over the course of 2016. And again, the low interest rate arena has weighed on this fund. For the first time in a decade, interest rates rose in the United States, and they rose twice in 2016. That's good for investors because we get better yields. However, the value of that fund dropped just a bit, but that is completely overshadowed by the steady march of dividends that this fund gives. So there are actually gains if you invested in this bond fund in your 401k because you were reaping the rewards of dividends. You were also getting dividends from the Developed Markets Fund. So perhaps this was not a big loss after all either. The big winner were domestic stocks. So if you had this fund, you had a 10.91% return on your investment. In total, this portfolio that you were invested in via your 401k or your 403b returned 7.41%, which was $5.43. That's, of course, if you held 1 share in each of these funds. More realistically, Hopefully you'd be investing month after month some amount of your paycheck. 10% is a good amount, and you'd be funding this 401k portfolio and accumulating shares of these funds little by little, perhaps in a ratio of 25% bonds, 75% stocks, and then you can divide up perhaps 20% international and 80% domestic stocks. And you'd be getting a pretty great yield. Since we invested only in one share at the beginning of the year, that gave us a starting point of $73.27. As we see here, we ended the year with $78.70, which was $5.43. Now for comparison, just for fun, if I pull up a bank interest rate calculator and say we deposited $73.27 in this bank, and we were getting a 1.50% API. We held the money there for 12 months with daily compounding and no additional deposits. We'd finish the year with a cool $74.38. Obviously less than our portfolio. But wait a minute, 1.50% from a bank? Most likely, your local bank is not giving you this amazing yield. Most likely, you're getting something like 0.10%. So you weren't going to get 74.38 out of that. You were going to get 73.34. And if you've got one of those fancy high-yield savings accounts at 0.15%, you're still getting not very much. So our 401k portfolio fared much better. And this doesn't even take into account all the dividends we were getting from all of these funds. So we actually made a lot more than 7.41%. We made a lot more than $5.43. Lastly, our ETFs portfolio. We have these 4 ETFs, 1 of bonds, 3 of stocks. We've got some domestic and international, as well as high-performing dividend yielding picks. On the last day of 2016, pretty much everything was down except the bond fund. The worst hit was our total world ETF lost 43 cents to close at $115.32. Well, again, one day does not a stock portfolio make. Let's look at it in the longer term. Since purchase, our bond ETF has yielded 0.5% or 4 cents. Our total world ETF has yielded 7.68% or $4.35 to close the year at $61. Our total US stock market ETF yielded 12.24% or $12.58 and finished at $115.32 per share. And our high dividend yield ETF gave back 14.89% or $9.82, closing at $75.77. We started the year with 1 share of each of these ETFs, and that cost us $306.09. We ended the year with $332.88, which was a $26 increase, or 8.75%. Again, only $26 in 1 year to show for our investment? Yes, those are the hard values of owning 1 share each. But let's bring back our bank calculator again. If we had deposited $306.09 at a bank that gives us an amazing interest rate of 1.50, in 1 year we would have $310.72, clearly below our $332. If we compare that with a more realistic interest rate that you get from a common brick and mortar bank, which is often 0.15% or so, you'd end up the year with $306.55. That's about 50 cents increase if you just stashed your money in the bank. Well, if you took that money and instead invested it in some of these suggested ETFs, we got $26.79 in 1 year. And so to recap, our tech stock portfolio had an increase of 6.77%, our 401k portfolio had an increase of 7.41%, and our ETFs had an 8.75% increase. How did your portfolios do this year? Hopefully better than ours. But if they didn't, make sure you subscribe to our channel to get some of the best advice in how to navigate the waters of your financial success. This has been Victor Campos for the VMC Inc. Financial News Network. Happy investing in 2017!